Alright, welcome to another walkthrough of the weekly S&P 500 ChartStorm. And this is just going to be going through, adding a little bit of extra comments and context around the 10 charts. Starting off with number 1 here, and remark that this is the ceiling and the floor. So it needs, I think, a little bit of extra explanation, this one. So first of all, that top line probably needs no explanation. You can see that there's been a sort of series of lower highs, and in and of itself that's something to be definitely mindful of. And the other line is this 200-day moving average, which so far has managed to hold up as a bit of a floor. But the other line, which I haven't drawn here, you'd probably draw it around the 2575 line there, so it's kind of around there. So if you could imagine that a line being in place there, then you've got what chartists would call a descending triangle. So descending triangle is the top line is descending and the bottom line is flat. If you decided to use the bottom tails of those two candles there, you could almost argue that it's a symmetrical triangle, but for the sake of argument, we'll call it the line there. It kind of lines up with the support / resistance zone of around November last year. And I mean, this kind of pattern can certainly be a continuation pattern if we get a breakout to the upside, or a reversal pattern if we get a breakout to the downside. So if you want to keep an eye on levels, and it's always interesting, I think, to be mindful of some of the key levels. So 2575 is going to be pretty key level to the downside. So when it comes to thinking about risk management, I think that that's going to be pretty key level, and along with, of course, the 200-day moving average. And we're for the market to kind of shake out this sort of malaise or middling, then that top line, which is going to be a moving target, it's going to be key. So I think that's it's a pretty important chart for the short-term dynamics. And a couple others here on the short-term dynamics, and these are what you call intermarket charts. So it's taking the S&P 500 and another market and trying to draw out some insights from what's going on, either separately in that market or in relation to each other. And so the first one here, you've got IEF, which is Treasuries ETF, and basically because bond prices move inversely to the yield, it's basically showing you the yield inverted. I could have put the yield in here and shown it as inverted, but if you look at the 10-year Treasury, it's on the verge of breaking out. So I might see if I can just bring that up actually, because it's pretty key. So yeah, I mean, you can see there, when you show it in price term, bonds are selling off, and we got that big sell-off of bonds early in the year, which ultimately I think is at least one thing behind that sharp correction. And by the time you got to early February and late Jan, there's this scenario where both bonds and stocks were selling off together, which for diversified portfolios, kind of the nightmare scenario in many ways. And so if we can see this chart here, clearly we're breaching that, well, pretty much just breached. They're brushing up against it. So as I said, on the verge of breaking out. If we just look at a little bit more history there. Yeah, so, and I think that the macro backdrop certainly is supportive for another push higher in yields. And if you've been following the blog, you would have noticed a reset in the bond sentiment indicator. So I think certainly the path is clear for a push higher in bond yields from this point, and that could lead us into another scenario where bonds have another significant sell-off, and that could be a catalyst for another leg down, or certainly a headwind for stocks, is that as bond yields move higher, it tends to it squeezes the equity risk premium, which is one key factor for certainly at least bonds and equities on a relative basis. And onto the other intermarket chart. This one is showing ASHR, which is an A-share ETF, basically just showing you the course of Chinese stock market versus the S&P 500. You can see there that the Chinese ones have taken a bit of a move to the downside there, and had initially diverged away from where the US stock market had been. This one, I guess it depends on what kind of story you want to tell. You could say, this is a case of the trade wars playing out, and maybe one or the other is winning or losing more. But the other thing that I would note on that is that you look at the macro backdrop in China, and yeah, the Q1 data was pretty decent in the scheme of things, but some of the forward-looking indicators there that I'm watching are saying that base case is a bit of a slowdown there this year. I'm not really outright bearish as such on China, but certainly can definitely see a slowdown scenario playing out this year, and one area that would play out would be in the stock market there. And given how important China is in the global economy, that the reason why these two would be relevant to each other is because if you saw China taking a more notable slowdown, then that's going to ripple across the global economy. So it's one to be mindful of. Next one is an analog chart. These analog charts can be a little bit dubious. You always got to take them with a grain of salt. I guess you could even argue that these two little dips down are what is supposed to happen down there, but I don't know. It's showing you the course of the stock market during the presidencies of JFK and Trump. I'll just leave it at that, and you can take what you want from that one. And moving on to the next one, this is a picture of the yield curve. So it's a 10-year minus 2-year Treasury yield, and this has become a topic of conversation again as the spread has moved below 50 basis points. Talked about this a bit in the latest weekly report, showed the trends in global yield curves, which is a lot less flattening than what we've seen here. And the other thing is showed it versus some of the broader business cycle indicators, and really it's quite normal to see the yield curve flatten as the cycle matures. And this little table that's been accompanying this chart, you can see there that from when the yield curve falls below 50 basis points to when it outright inverts, the record of stock market performance has actually been fairly decent. That 147% there is probably a bit of an outlier, but the rest of them, fairly decent performance really. And so far from being something to necessarily worry about. I mean, you do get somewhat concerned as the business cycle matures, because the logical conclusion of a maturing business cycle is the end of the cycle. But I don't think we're there yet, so I guess it's kind of a benign picture there, arguably slightly positive. And the next one, pretty positive picture there as well, so showing the earnings revisions indicator, kind of momentum of earnings revisions. It's a mix of the earnings revisions ratio and 3-month rate of change in forward EPS. And had a big boost from the tax cuts, obviously, but the trend prior to that was pretty decent anyway. And the US nominal surprise index, that's a combination of the economic surprise and inflation surprise, basically whether the inflation and economic data is coming in better or worse than expected, and it's on the positive side. So pretty much what we've got here is that the earnings macro pulse is still looking pretty decent, and again pretty much the opposite of what it was in 2015-16, where those two corrections were as much to do with concern about the growth outlook. Not so this time. This one here has got a picture of earnings and valuations, and you can see there that across these countries, so we've got Japan, emerging markets, Australia, Europe, alongside US. US is clearly good, and that boost from the tax cut. But then you've got Japan's doing all right as well. I mean, Japan didn't get tax cuts. Same thing with emerging markets in Europe. All trending in a pretty decent direction here, and that reflects the global synchronized strength, particularly in developed economies. And on the valuation picture, you see there that they're all sort of around fair value. Japan's a little bit below, or below long-term average, I should say. I mean, fair value versus long-term average, two different things, arguably. But you can see there that one thing that you can certainly say is that US stock market is more expensive than the others. Certainly nothing to be concerned about there as such. There's no extremes, which is something that you always want to be looking for. But relative value there is also quite interesting still. Number 7. Nope, number 8. Just checking. US assets, valuation versus history. This is the three major asset classes really: treasuries, S&P 500, and property, residential property. And on all of these asset classes, they're all in the expensive side. They're far from where they got to, in property in the case of, the mid-2000s, or the stock market in the late 90s. Far from the extremes that we saw there, but it is kind of extreme to see all three of them on this side of the line, and particularly extreme or extraordinary given what's going on with monetary policy, which is the experiment's coming full circle. So it presents a challenge for investors, challenge for asset allocation. This interesting picture shows you how S&P 500 companies have used their cash and are expected to use their cash in 2018. You can see there that the companies are expected to return about 46% of their cash to shareholders through dividends and buybacks, and that is its highest it's been since back in 2014. And well, I guess if you think about the impact of the tax cuts, whether it's those sort of indirect effects which makes them repatriate capital, or just the fact that earnings are looking better, so the cash flow situation is going to be better, and the fact that the proportion is going to be a little bit higher, then this year is going to me seeing more flows from corporates on terms of buybacks, so more, greater volume of demand for stocks this year, and greater volume of dividends as well. So growth in dividends is going to be remaining pretty decent. If this chart is anything to go by, both of those factors, all else equal, tend to be pretty positive for stocks. And last one is this quite interesting sort of food for thought chart. You can see here that there's the clear trend and there's some clear cycles. So what is this chart? It is the average company lifespan on the S&P 500 index. And it's actually set to, by their forecast, set to reach a record low in a few years time. And yeah, it's quite an interesting chart, really. I guess a representation of disruption or or the cycle of creative destruction. There does seem to be this cycle around the broader market business cycle. So, when the cycle's pretty good, the lifespan tends to be a bit higher. When, you have a bit of market disruption, tends to go down. Anyway, yeah, in terms of the longer term trend there, I guess it speaks to, the march forward of progress of technological innovation, globalization. It's also interesting from a index investing standpoint. So passive investors, they actually kind of benefit from this because the index is constantly changing, rotating, and basically rotating into new industries and rotating out of sunset industries, just by virtue of the companies coming and going, but also by virtue of market cap weighting, which is can be a good thing over the long term because it means that you're not caught holding companies that are going obsolete. But it does mean that the makeup of the index is always changing as well, and that can potentially lead to unintended consequences or unexpected allocations. For example, S&P 500 has now got a quarter percent, just over a quarter of it is technology companies, and although interestingly that it's going to change later this year as the sector classifications are going to shunt some of the what we term technology companies into consumer companies, etc. Might have to write something up on that later on, but anyway, bottom line things change. And so I'll leave it there at this point, but I guess, if you were to wrap these sort of charts together, you've got this positive earnings macro backdrop against the short term couple of sort of concerns or warning signs or cautionaries. So it's kind of, in the write-up I talked about it being finishing the week in the middle and almost being stuck in the middle. So, and the last line I wrote on the write-up, if you want to read the write-up, I'll put the link in this description. It's almost like Yogi Berra's famous misquote or quote is, when you come to a fork in the road, take it.